Welcome to the deep dive. Today we're going to dive deep into candlestick charting.
Yeah, it's a really visual way to look at markets.
Absolutely.
Yeah.
You sent over Tina Logan's Getting Started in Candlestick Charting, and we're planning to pull out the essentials, give everyone a solid feel for how these charts work.
Right. Without getting too bogged down in every single detail.
Exactly. Think of it like learning a new language for market sentiment.
Yeah.
What are the buyers and sellers actually saying?
And Logan's book, it's a great starting point. It really focuses on spotting those reversal patterns.
Those turning points.
Yeah, and understanding the psychology behind them. What's also great is how she talks about blending this, Eastern technique with Western technical analysis.
Combining the best of both worlds, kinda.
Precisely. Gives you a much richer picture.
So our mission here today is really to nail down the basics. How are these candles actually made? What do they tell us about that tug-of-war between bulls and bears? And, crucially, how can you start spotting signs that the price might be about to change direction?
Right. We want to give folks some practical knowledge they can actually use.
Yeah, whether you're actively trading, just managing investments, or maybe you're just curious about how market psychology shows up on a chart.
Okay, so where do we start? The building blocks.
Let's do it. The anatomy of a candlestick.
All right. So each candle, it's like a snapshot of one trading session. Could be a day, an hour, even 15 minutes, whatever time frame you set.
Right.
And it's got two main parts. The main blocky bit, that's the real body.
Okay, the thick part.
Yep. And then you've got the thin lines sticking out. Those are the shadows, or sometimes called tails.
Okay, real body and shadows. So that real body, what's its main job?
It shows you the distance between where the price opened for that session and where it closed. Simple as that.
And the color matters
Right.
big time.
A white body, or sometimes hollow, depending on your charting software, means the close was higher than the open. A bullish session.
Bulls won that round.
Exactly. And a black body or filled in means the close was lower than the open. Bearish session. Bears took control. Logan points out that, yeah, black and bearish, white and bullish. They're basically synonyms here.
Got it. So one glance at the body color tells you the net result for that period. Now, what about those shadows, the tails?
The shadows tell the rest of the story, the full price range explored during that session.
The extremes.
Right. The upper shadow stretches from the top of the real body up to the absolute highest price hit during that time. And the lower shadow goes from the bottom of the real body down to the lowest price traded.
Okay. So putting it together, the body's height and color show the main push and who won, bulls or bears. And the shadows show how far things stretched, like how much of a fight there was beyond the open and close.
You got it. They show the extent of the battle.
This is where it gets really cool for me. How does that single daily candle capture all the chaos that can happen inside a trading day?
Well, yeah, the daily candle is kind of like the final score, isn't it? But the intraday action, that's the play-by-play. Right. If you zoom into, say, a 15-minute chart for that same day, you see all the back and forth. Logan gives an example. You might see a long white daily candle, looks totally bullish, right? Small upper shadow.
Seems straightforward.
But the 15-minute chart might show the bears actually pushed the price way down early on before the bulls staged a massive comeback later in the day. So much more volatility than the daily candle alone suggests.
Ah, I see. So the daily summarizes, but the intraday reveals the struggle. And the book mentions specific times of day being more active.
Definitely. Logan points out the first, say, 30 to 60 minutes. Often pretty wild.
Why is that?
Well, you've got reactions to overnight news, economic reports maybe just came out.
Market orders hitting the system.
Exactly. Plus, you get what some experienced traders kind of jokingly call amateur hour.
Okay.
Less experienced folks making quick, maybe emotional moves right at the open. These quick reactions can sometimes cause those longer shadows on the candle that forms.
Amateur hour. I'll remember that one. What about the end of the day? The close.
Also super important, last 30 to 60 minutes, you get automated systems placing on close orders.
Oh, okay.
Day traders are often closing out positions. In futures, margin calls get finalized, and sometimes the big institutional money makes moves near the close.
Right.
And that closing price itself, it's widely seen as maybe the most important price of the day. It's the market's final verdict for that session.
The final assessment. Okay, that makes sense. So we've got the pieces, open, close, high, low. We see how the intraday fight shapes the candle. Now, the really juicy part, Reversal patterns. What are these telling us?
Okay, so these patterns, they're specific shapes, usually one or maybe a few candles together, that suggest the current price trend might be about to change direction.
Might be. Not guaranteed.
Exactly.
Yeah.
That's critical. They signal a potential shift, but they don't tell you how long that shift will last or how big the move will be. It's a warning sign, basically.
A heads up. And Logan warns against just jumping into a trade based only on seeing a pattern, right?
Absolutely. She stresses that you always need to think about the reward versus the risk. Is the potential gain worth the potential loss?
Makes sense.
And she also suggests, especially when you're learning, focus on really understanding like a handful of key patterns really well. Know the psychology behind the shape. Don't just memorize names.
Quality over quantity. Got it.
Yeah.
Okay, let's tackle some bullish reversals then. These pop up after a price drop, suggesting things might turn up. First one, the hammer. What's that look like?
The hammer.
Okay.
Single candle. Shows up after a downtrend. It's got a small real body, usually up near the high of the session.
Okay.
And a long lower shadow, like at least twice as long as the body. And very little, or no, upper shadow.
So small body, long tail hanging down.
Exactly. That long lower shadow means sellers pushed prices way down, but then buyers stormed back in and pushed it all the way back up to close near the high. It's like the market's hammering at a bottom, as the book says.
Hammering at a bottom. Nice visual. Okay, what about the inverted hammer? Sounds like the opposite.
Kinda, but still bullish potential. Also, a single candle after a decline. Small real body, but this time it's near the low of the session.
Right.
And the long shadow is sticking upwards. Long upper shadow, again, at least twice the body length. Little or no lower shadow.
So like an upside-down hammer after a fall, what's that telling us?
It shows buyers tried to rally hard during the session, pushing prices up, but they couldn't quite hold it there by the close. So it suggests potential for an upward move, but you usually want to see some confirmation on the next candle. Like, does price actually move higher?
Right. Needs a follow-through. What's next for bullish signals?
The bullish engulfing, this one's a two-candle pattern.
Right.
You have a bearish black candle first, then the second candle is bullish, white, and its real body completely swallows or engulfs the real body of the black candle before it.
Engulfs it entirely.
Yeah. This is often seen as a pretty strong signal because it's such a clear visual shift. Buyers just completely overwhelm the sellers from the previous session. That can trap sellers, maybe force them to cover, adding fuel to the upward move.
I can picture that. A total takeover. Okay, then there's the piercing pattern.
Right, another two-candle bullish pattern. Often happens near a support level. First candle is a long black one, continuing the downtrend.
Still bearish.
Then the second candle opens lower, like it gaps down below the first candle's low, but then it rallies strongly. It closes well up into the body of that first black candle, needs to close at least halfway up the first candle's body.
So it gaps down, looks bad, but then pierces back up into the prior candle's range.
Exactly. Suggests the selling pressure got hit hard by buyers stepping in.
Okay. Now, we've got these doji things mentioned. What's a doji, just generally?
Ah, the doji. It's basically a candle where the open and close prices are almost identical. So the real body is tiny, like a thin line, or sometimes non-existent. Looks like a plus sign or a cross.
And what does that mean?
Generally, indecision, a stalemate. Neither bulls nor bears could really gain control during that session.
Okay, indecision. So how can a southern doji or a dragonfly doji signal a bullish reversal after prices have been falling?
Well, the southern doji is just a doji appearing after a downtrend. If it has a long lower shadow, it shows there was volatility. Sellers tried pushing down but were met with some buying. But Logan cautions they aren't always the strongest signal in a falling market.
Less reliable, maybe.
Yeah, potentially. The dragonfly doji is more specific and potentially stronger. It's a doji with that long lower shadow but almost no upper shadow. It looks like a T.
Right.
This can be a better signal, especially if it forms near a known support level. That long lower shadow shows sellers really tried, pushed it down, but buyers completely rejected those lower prices and brought it right back to the open.
A strong rejection from below. Okay, last one on the bullish list. The morning star. Sounds promising.
It can be, yeah. It's a three-candle pattern. Starts with a long black candle, the downtrend is still on.
Okay.
Then the second candle is a small real body. Black or white doesn't matter too much, and it gaps down below the first candle. If this middle one is a doji, it's a morning doji star, considered even stronger.
A gap down, small body, like a pause.
Exactly, a pause or indecision. Then, the third candle is a long white candle that closes significantly back up into the body of that first black candle.
So down, pause, then strongly back up.
Yep, tells a story. Downtrend, losing steam, Indecision, then a powerful bullish reversal. Signals the potential start of an uptrend.
That paints a clear picture. Okay, let's flip it. Bearish reversals. These show up after a price climb, suggesting a potential turn downwards. First, the hanging man. Ominous name.
It is, and it looks exactly like a hammer. Small, real body near the top, long lower shadow, at least twice the body, little or no upper shadow.
But you said it's bearish.
Yes, because of the context. It appears after an uptrend. That long lower shadow, even though price closed near the high, suggests significant selling pressure came in during the session. It raises a red flag for the bulls. Are sellers starting to test this uptrend?
Context is everything. Same shape, different meaning depending on the prior trend.
Got it.
Next, bearish engulfing, the opposite of the bullish one.
Exactly right. 2 candles after an uptrend. First candle is white, bullish. The second candle is black, bearish, and its real body completely engulfs the real body of the white candle before it.
Sellers swamp the buyers.
Pretty much. Considered a strong sign that the tide might be turning downwards.
Makes sense. What about dark cloud cover?
Another 2-candle pattern, bearish. First candle, long white, continuing the uptrend.
Still looks good for bulls.
Then the second candle opens higher, gapping up above the first candle's high. Looks even better initially.
Uh-oh, I sense a but.
But it then sells off and closes deep into the body of that first white candle. Needs to close at least halfway down the prior body. The deeper it closes, the more bearish it's considered. If it closes below the open of the first candle, it becomes a bearish engulfing.
So a gap up, failure, and a dark cloud descends on the rally. Okay. Now, the northern doji. How does a doji become bearish after an uptrend?
Again, context. A doji after an uptrend still means indecision, but if it has a long upper shadow, that's significant.
Why the upper shadow?
It shows buyers tried to push prices even higher, but sellers stepped in strongly near the highs and pushed it back down to the opening closing level. Suggests resistance. The uptrend might be hitting a ceiling, especially potent if it follows several strong white candles.
So, inability to hold the gains. Stalling momentum. Okay. Then, gravestone doji. Even more ominous.
Yeah, this one's pretty stark. It's a doji with a long upper shadow, but virtually no lower shadow. Looks like an upside-down T.
Okay.
Occurring after an uptrend, especially near resistance, it's quite bearish. It shows bulls made a big push higher, but bears completely rejected it, slamming the price right back down to the open, like a gravestone marking the high point.
Bulls tribe got totally shut down.
Lamb picture.
Okay, shooting star.
Similar idea, but with a small real body. Single candle after an uptrend. Small real body near the low of the session. Long upper shadow, at least twice the body. Little or no lower shadow.
So like an inserted hammer, but after an uptrend.
Exactly. Buyers pushed up, long upper shadow, but sellers drove it back down, forcing the close near the low. Suggests the upward burst failed, potential weakness, like a star falling from the sky.
Got it. Last one. Evening star. Counterpart to the morning star.
Precisely. 3 candles, bearish reversal, starts with a long white candle. Uptrend continues.
Okay.
Second candle is a small real body, black or white, that gaps up above the first one. Again, if it's a doji, it's an evening doji star, maybe even stronger.
Gap up, positive indecision.
Then the third candle is a long black candle that closes significantly down into the body of that first white candle.
Up, pause, then strongly down.
Yep. Mirrors the morning star's logic, but signals a potential shift from bullish control to bearish control. The party might be over for the bulls.
Okay, that covers a lot of the key reversal patterns. But the book also mentions neutral patterns. What's their deal?
Neutral patterns, yeah. They don't strongly signal a reversal, more like indecision or maybe just high volatility. The spinning top is one. Small real body, roughly centered between an upper and lower shadow of similar lengths. Kind of looks like a toy cop spinning. It just shows buyers and sellers fought back and forward, but neither really won.
Indecision. A balanced fight. No clear winner. What else?
The high wave candle. Think of it as a spinning top with really long shadows, or a doji with really long shadows. That's a long list.
Exactly. Long upper shadow, long lower shadow. Shows a lot of volatility during the session. Price swung way up, way down, but ended up closing near where it started. Logan says the intraday chart would look like a roller coaster. Huge battle, but ultimately indecisive.
Wow, okay. Lots of sound and fury, signifying. well, uncertainty.
Yeah.
So we've got all these patterns, but you mentioned context earlier. How crucial is that, and what about confirmation?
Hugely crucial. Like we said with the hanging man versus the hammer, a pattern's meaning depends heavily on where it appears. Reversal patterns are much more significant after a clear trend up or down.
Not when price is just chopping sideways. Right. Sideways movement or consolidation often works off any overbought or oversold conditions anyway. So a pattern there doesn't have much of a trend to actually reverse. You need a trend first.
Makes total sense.
Yeah.
What else about context?
Where the pattern forms matters too. A bullish pattern, like a hammer, appearing right at a known support level, much stronger signal. A bearish pattern, like a shooting star, right at a resistance level, same idea, more reliable. And the overall market helps or hurts too. A bullish pattern in a single stock might fail if the whole market is tanking, you know.
Right, the general tide. Okay, and confirmation you need to wait sometimes.
Often, yes. It boosts confidence. Saw a bullish hammer, maybe wait for the next candle to close higher. That confirms buyers are following through.
Okay.
Saw a dark cloud cover, maybe look for price to trade below the low of that dark cloud pattern on the next day. That confirms the bearish signal. Logan really emphasizes combining candlesticks with other technical tools, support resistance, trend lines, volume.
The Western stuff.
Yeah. When multiple things line up confluence, they call it your odds improve. A hammer at support with rising volume. That's a much stronger case than just the hammer alone.
Building a case with multiple clues. Got it. Now, Logan's book goes further, right? Beyond just these patterns.
Oh yeah, definitely. Part 2, East Meets West, is all about that integration. She talks more about analyzing the tails, the shadows themselves.
What they imply.
Right. And then she connects candlesticks to price analysis, volume, volatility, how they all work together. There are chapters on trends, identifying them, spotting changes using candles and trend lines.
Right.
She covers gaps, too, those empty spaces on the chart, and digs deep into identifying good support and resistance levels.
So it really layers everything together, takes the foundation of pattern and builds a more complete analytical framework.
Exactly. And the end of the book, it's very practical, how to actually use these patterns in trading, managing risk, plus practice exercises.
Helping you spot them on real charts.
Yep. How to use them for potential entries. Maybe to confirm signals from other strategies, or even as like an early warning to take profits on a winning trade. She mentions risk management is vital, needs more study, but the practice sets are great for training your eye.
Okay, wow. We've covered a lot of ground here. It's really just scratched the surface of candlestick charting in this deep dive. But hopefully everyone listening has a much clearer picture now of how to read these visual stories.
Yeah, you've got a basic toolkit now to look at charts differently, maybe spot those potential turning points we talked about.
What part of this analysis really jumps out at you? Or maybe are there specific patterns you're now kind of curious to watch for?
It's definitely a journey. The more you look, the more subtleties you start to see. It's not just mechanical pattern recognition.
Keep an eye out for these shapes when you're looking at market data. Think about the story each candle tells that daily battle. It's a dynamic way to try and grasp the forces driving the price.
And maybe the final thought to leave folks with is, how might understanding these patterns change how you think about risk or opportunity in the markets?
Yeah. And it's more than just shapes, right? It's about trying to decode the underlying message about market psychology and potential shifts.
Exactly. What is the market potentially telling you?